All right, so Joseph writes in, he needs having a hard time understanding bond funds. So let's see what he says here. He goes, hey, Josh, hope all is well. You're the best. I wish I was as handsome as you. I wish I was as smart as you. You're the best. How come I can't be more like you? Then he gets down to the meat and potatoes of it. He actually didn't say that. I'm being silly. That was pretty funny. When inflation concerns started to crop up at the end of 2021, I purchased about $50,000 of VIPSX as an inflation hedge. At the time, the share price was $14.61. I assumed with a 10-year Treasury yield rising over the last 6 months that the VIPSX would do the same. It hasn't done it. It's actually down to $11.86 right now, at least as of yesterday. I know I'm thinking about the share price the same way I look at a stock fund, and this might not be correct. I see I'm getting quarterly dividends from VIPSX, so maybe that's what I'm missing. Any insight you can have, be welcome. Okay. All right, so always remember, any bond, the current price will drop when the interest rates rise. It matters not. Any bond. Zero coupon bonds. Long-term government zero coupon bonds get smoked when the interest rates rise. Doesn't matter. It doesn't matter. Everything goes back to equilibrium, and I'll prove that here in just a second. So always remember, when interest rates rise, the price of your bonds that have already been issued drop. It's literally nothing could be. It's as guaranteed as Einstein was a plagiarist. All right, just keep that in mind, because you know he was. Come on, Einstein. Come on. They got these Verizon things with "Hello, Einstein." I said plagiarist every single time. Plagiarist. Anyway, so all right. So let me show you something here. We're going to go to Portfolio Visualizer. We're going to look at this Vanguard Intermediate Term Treasury Bond Fund. All right, and I just want to show you something here. Bonds are so doggone easy. I want to show you the portfolio composition. All right, so they get 85 bonds in here. The average maturity is about 6 years. All right, so the 85 bonds, average maturity is about 6 years. All right, on top of that, the yield to maturity is 3.7. All right, so let me show you something here. What did that fund do the past 10 years? Oops, there we go. So the past 10 years, the Vanguard Intermediate Government Treasury Fund, I think it's the Treasury. Yeah, Vanguard Intermediate Treasury Fund did what? Did I already miss it? 1 second. Right here, I gotta go summary. Over the past 10 years, it averaged 0.7%. That's it, 0.7%. If we look at the chart here, we can see it went from 10 all the way up to 12 and all the way back down. Average 0.7%. So it dropped from 12,207 to 10,722 over the last, let's see, about a year and a half or so, I suppose. 12,234 down to 10,722. That's a 14% decline. I thought I saw someplace in here. The worst draw now is a 14%. Yeah, right there. 14% decline. Yeah, so drop 14%. Hey. All right, no. Finn, come here. Hey, 1 second. Now, what happens is it was at 10,000 before. It went all the way up to here to 12,206. Not a great return over 8 years, I grant you, but still, you made $2,000, and that's back down here. And people are like, I'm losing money. No, you didn't. You got exactly what you should have expected. The compounded annual growth rate is almost to the basis point exactly what you should have expected if you bought this 10 years ago. How do I know? U.S. Department of Treasury. Bond rates. We're going to look at 5-year bonds because remember, the average maturity is about 5.5 years or so. And we're going to say, whoa, look at that. January 2nd, 2013. 5-year treasuries are paying 0.76%. 0.76%. What did the 5-year Treasury Bond Fund give us? 0.70%. Look at that. Look at that, baby. It's, like I said, almost to the basis point, you know your rate of return. So we know what our rate of return is going to be basically as of what the yield is right now. And we already said the yield to maturity on this guy was what? Oh, wait, I got to go over here. It's 3.7%. There's an SEC yield 3.83. But I'd actually look at yield to maturity 3.7. That's what we're going to get. So what the current yield is what you're going to get over the next 10 years. Does that mean you get 3.7 every year? No. Look at this. We didn't get 0.76 every year. We got from here to 2023 to 2020, we got our compound annual growth rate was 2.57, which is well above what we got to start the decade in 2000 and what is it, 12 or 13 when we first got these bonds. That was impossible. That had to revert back to it has to revert back. It always does, because you're saying we bought these bonds at 0.76. I can't get a higher rate of return than 0.76. It's impossible, man. I just can't, because they have to mature in 5 years at 0.76. It's just that simple, man. Now you can say, yeah, but Josh, those bonds sold out in 2018. All right, let's go look at 2018. It's the same thing. I was just using a 10-year rate of return. We go to 2018, boink. And what are they paying there? 2.25. So 2.25 is what you should expect if you bought this fund right here. Now this is a Vanguard. What was I going to say here? This fund actually has other bonds. It's not all that. I'll show you the portfolio composition. So they have bonds in here that are a little bit 7 to 10 years, 20%, 7 to 10, 3 to 5, 25%, and the bulk are 5 to 7. So it's not exactly 5-year bonds. I grant you. It could be 3 years, it could be 10 years. You even have some longer term bonds. So it's not literally exact. But it's just that simple, man. What your current rate of your current yield to maturity is what you can expect on your bond. That's it. No more, no less. Now, the interesting thing with inflation bonds, my guy said the interest rates went up. I thought my inflation bond would go up. No. Bonds all go down when inflation goes. When interest rates go up, bonds all go down. It's just that simple. All right, so always remember that. So if you would have bought a bond in 2005, 2018, a 5-year bond, you'd expect to get 2.25% a year. All right, that's a solely a 5-year bond. I got to be very clear there, because I probably wasn't stating exact, but still, if you would have bought a 10-year bond, you'd get 2.46. If you went back into 2013 like we did before, your 5-year bond would have got 0.76. Your 10-year bond would have got 1.86. So if you could do a sole 10-year bond fund in here in Portfolio Visualizer, I can almost assure you your 10-year bond fund would give us 1.86. I don't know if there's anything a solely 10-year bond fund. I don't know. Intermediate is, like I said, 5 to 7 years essentially, but you get the gist. Anyway, point being is everything it all goes back to the yield at the time of purchase. It's just that simple, man. Don't make it harder than it needs to be in bonds. You're going to get what you get. On any given year, it could be off, because last year was literally the worst year of bonds any of us have ever seen. All right, now I imagine those will probably come back. We'll probably get more as a make good from how bad it was last year. But again, look at that, dude. I mean, well, not that guy. That guy right there. Oops. Where was it? Right here. Summary. And look at that. That's for 5 years. 2.57. Is that for 5 years? Well, that's for 2020, excuse me. And so then you're sitting there thinking, I got let's see what it did for 5 years. I'm just curious. 2013 to 2018, let's see. I bet it's going to be close to 0.76. Yeah, look at that. I mean, it's that spot on, man. So, it's just, because this is a sole 5-year bond fund, so it's not quite as perfect, but it's pretty doggone close. What you see is what you get, man. That's all there is to it. What you see is what you get. Anyway, hope that helps, man. Don't change out your investment portfolio just because, oh my goodness, you're trying to beat the market or time the market. Yeah, I just gotta say, can I afford to take the hit? If you can't afford to take the hit, make sure your portfolio is more conservative. That's all there is to it. All right, love your thoughts. We'll see you